Here's a story that sounds completely backward. A central bank raises interest rates, and its currency tanks. But there are no crisis headlines, no market panic. Just markets doing what they do. Today, let's unpack what's really happening with the Japanese yen and why this is a story about deep structure, not just daily news. I remember when I was at Goldman, sitting through a Federal Reserve meeting where they hiked interest rates. Logically, the US dollar should have jumped. Instead, it fell. Totally confused. I went to the head of currency trading and asked him how that was possible. His answer was simple and unforgettable. There were more sellers than buyers. That's the exact lesson we need to understand Japan right now. The Bank of Japan has started raising rates for the first time in years. Yet the yen keeps getting weaker, sliding to lows we haven't seen in decades. On the surface, that makes no sense. Higher rates are supposed to make a currency stronger. But foreign exchange markets don't just react to headline. They move on incentives, on balance, and on what they expect to happen years from now. To really get this, we have to look past the short-term noise. A great way to do that is by looking at the yen through a trade-weighted view, which compares it against a whole basket of other major currencies. We can also compare long-term interest rate differences using something like 30-year government bond yields. Why 30 years? Because big, long-term money isn't chasing quick wins. It's looking for stability and good returns over decades. This year, Japan's long-term yields have actually risen quite a bit. In theory, that should make Japanese bonds more attractive to global investors, which would support the yen. But that support just isn't showing up. And that's not a contradiction, it's a signal. The real reason is hidden in how Japan's bond market works. Japan has one of the highest levels of government debt in the developed world. Normally, that much debt would mean the government has to offer much higher interest rates, or yields, to convince investors to lend it money. But in Japan, yields are still super low. That's because the central bank itself is a massive buyer of its own government S-bonds. This constant buying keeps the yields artificially low. But when risk isn't priced into the bonds, it has to show up somewhere else. And in this case, it's showing up in the currency. Simply put, the market is saying, yeah, long-term rates have gone up a little, but nowhere near enough to cover the real long-term risks of holding all this debt. And since the adjustment isn't happening through interest rates, it's happening through the exchange rate instead. That's why the yen is weakening, even as the central bank tries to tighten policy. This doesn't mean a crisis is coming tomorrow. It just means investors are getting more and more sensitive to Japan's long-term financial health. Currency markets often act like a pressure valve, releasing steam slowly instead of all at once. From a global view, the message is clear. A currency S, stability, ISNT, just about today's interest rates. It's about how those rates stack up against the long-term fiscal picture. For Japan, this means that just hiking rates a little might not be enough to stop the yen slide. They need to convince long-term investors that the returns are worth the risk. Until that confidence is restored, the yen could stay under pressure, no matter what the central bank does in the short term. So, the big takeaway here isn't to panic or try to predict the next move. It's about understanding how markets really function. Exchange rates aren't just a vote on today's policy. They're a reflection of long-term balance. And sometimes, when a currency falls after a rate hike, it's not because the system is broken. It's because the market is quietly telling a much deeper, more important story. Thanks for watching. If you found this useful, don't forget to like and subscribe for more deep dives into how the economy really works.